Rees-Mogg this morning on the TV, in a round of interviews, denied that the problems in the markets were caused by the mini-budget, if we want to call it that, the fiscal event, whatever it was, and basically said that it was differentials between the pound and the dollar and what's going on in America, rather than the fiscal announcements that were made here. Is he right?
I didn't have the pleasure of seeing the business secretary this morning, so I want to comment on exactly what he said, but in terms of what we should focus on, I think I would listen more to the Bank of England's chief economist, who said to you very clearly that there was a clear UK component to what was happening.
That's John Cunliffe in his letter with the very helpful
I meant Hugh Pill, the chief economist, but the deputy governor also spelt it out in his letter to the chair very clearly. I don't think anybody who's spending their time, and unfortunately too many people are spending their time looking at UK gilt markets right now, thinks that there is only an international global element to what is going on. I mean, they're just really basic things like UK gilts were had a lower yield than US Treasuries until the recent past, and now they have a higher yield. There's lots of things. If you look at the spread versus German bunds, it's up significantly. So just look at the change over the last year, look at the change particularly since September on the costs of the yields on UK government debt. It's very clear that there's a UK-specific element to what's going on. That's what the Bank of England is telling you. I focus on what they're saying.
Does everyone agree that there are UK-specific elements to what's going on in the international markets as a result of the mini-budget or the fiscal event or whatever we're meant to call it? Everybody's nodding. Sanjay?
If I may, just to add, I haven't had the pleasure of seeing or hearing the business secretary's comments, but I think there are two components that need to be understood with this, and there's absolutely a UK component here. And one cannot disentangle that. But there's also a global component that also should be seen in the grand scheme of things. And when we look at markets and when we look at investor reaction, what we're seeing are two pieces of a puzzle that's sort of building itself together. And from a global perspective, we see market sentiment stretched, stressed. There's increased volatility, and there are a couple of reasons for that. One is the global geopolitical tensions. In large part, what we're seeing is Russia's invasion of Ukraine, and that's created a lot of volatility in the energy market specifically, as we know. There are other markets as well that has been affected, particularly the food market, and that's increased risk aversion in the markets. That's increased volatility in the market as well. And the second thing that we can't avoid talking about is high inflation. So central banks across the world, particularly in developed markets, are now fighting extraordinary inflation. What we're seeing now is an extraordinary synchronized global tightening cycle, which is creating a lot more uncertainty, a lot more volatility. So yes, there's absolutely a global component that can't be abstracted from what we're seeing. And that has resulted, as Thorsten mentioned, yields going up everywhere. But in the main, there's also an idiosyncratic UK-specific component. And that has to do with what the governor of the Bank of England has been talking about for months, for quarters, and that's really coming down to the terms of trade shock that the UK uniquely faces. And if you look at the trade balance in the UK, we're seeing some of the worst.
By that you mean the problem with Brexit as well, and not being able to get things over the border, the Northern Ireland Protocol, that kind of thing? Inclusive
of all of that. So if you look at the trade balance, and if you look at where the trade balance is, it's at a historic deficit. We haven't seen this kind of trade deficit since 1955, since national account records began. And when you throw onto that, the current external financing needs that are extraordinary, with the time going into September 23rd, the Chancellor's mini-budget, the ONS was talking about an 8.3% current account deficit. That's an extraordinary current account deficit. If you look across developed markets and emerging market economies, the narrow basic balance that the UK has is extraordinary. It's one of the worst amongst developed and emerging market economies. So the external financing needs of the UK are certainly a big function of what we're seeing. And then you throw on the September 23rd event, you've got a sideline fiscal watchdog, you've got lack of a medium-term fiscal plan, one of the largest unfunded tax cuts that we've seen, package of measures that we've seen since the early 1970s, and it's sort of the straw that kind of broke the camel's back, if you will. So not only has the UK's external financing needs increased significantly because of a lot of the fiscal measures that we've seen, it's put a lot more pressure for markets. And the one thing that I just want to maybe bring it back to is that given the global factors that we're looking at, given the idiosyncratic local factors that we're looking at, what we're seeing is increased market uncertainty, increased market volatility, and increased market illiquidity. And the reason why that's important is because small moves, small surprises that we see in the market tend to have bigger impacts. And so when we put this into context of what we saw on Friday, September 23rd, the small surprises that we had, the small moves, yes, in the grand scheme of things, it may not have been much. Largely, lots of these were leaked. Lots of the tax cuts that the Chancellor was planning were leaked in the government almost a month ago. But when we did see the big issuance projections increase from the DMO, £60 billion upgrade, the markets reacted. What we saw was a textbook response where investors were saying, yes, we need a cheaper currency to fund the current account deficit, and we need higher real yields, higher interest rates. So absolutely, I think I completely agree. There is a UK-specific component, but I think we shouldn't abstract away from the fact that there is also a global component.
Sure. But perhaps what you're explaining is that in those kinds of febrile and uncertain conditions, launching a sudden lurch of an experiment, trashing the local structures around which the Bank of England, the OBR, have traditionally worked, might not have been the cleverest thing to do.
I think markets are very sensitive to what's happening at the moment. And what we're seeing now from the government is that fiscal policy and monetary policy are moving in opposite directions. And what markets don't like, especially in this period of heightened uncertainty, heightened volatility, and very little liquidity in both the currency market and the rates market, is that inconsistency. I think they're worried by that. And I think that's what we're seeing.
The OBR has been sidelined. Tom Scholar was sacked. And there were noises during the Conservative leadership election which threatened the Bank of England's independence and its mandate. Do you think that that also has spooked the markets? There was then the presence of the Chancellor following the fiscal event on the Sunday news programmes where he hinted that there would be more tax cuts.
Yeah, I mean, we discussed this a bit on the session on the 20, maybe it was just the day before the fiscal, the mini budget that we're now calling it. I think it's wrong actually to think about it slightly as there's these international components and then there's this UK specific component. You shouldn't be doing the UK specific component exactly because of the wider environment, which is exactly what we discussed the day before the statement, and exactly what we discussed is what has transpired, except it's worse both in terms of the risk that was taken and the outcomes that have followed. So I don't think anyone should be surprised by what would happen. I think we're in this exact room discussing exactly what was going to happen.
I think you said this kind of policy isn't a joke, and you were quite
it isn't
angry,
a game,
but you would have been even more angry if you'd have realised what was going to be announced. I suspect.
Yeah, absolutely. And the bigger picture is obviously that, and I wouldn't, the big picture is, yes, firing Treasury civil servants isn't a good idea. That hasn't helped. Sidelining your fiscal watchdog hasn't helped. But the big picture, which is if you spend a summer telling people that you're intending to abandon fiscal orthodoxy, if you then announce a package that dumps fiscal orthodoxy, and then you say on the Sunday you're going to keep doing it, then I don't think any of this should be a surprise to any of us, that this is where you end up, and this is what happens if you aren't paying attention. And maybe you could have got away with that in more benign times. It wouldn't have been a good idea in any times, but you definitely shouldn't be doing it in the current climate when we're moving to a higher rates regime across the advanced economies. That brings with it a whole world of problems that we're going to be wrestling with, and the Chancellor and the Business Secretary, it sounds like, are right, by the way, to say that everyone is going to struggle with that to some degree. That's going to be hard for public finances. Debt costs around the world will rise. It's going to be hard for macroeconomic policymakers in general, because you're going to get this tension between fiscal and monetary policy as part of that mix, and you're going to have a big asset price changes in the mix. And so this is always going to be hard, but it's exactly because it was always going to be hard that you don't do this.
Yep. We now have a situation where last night the Governor of the Bank of England made it very clear that the market operations that they launched in the aftermath of the budget would last until the 14th. He then said, that's it, get it sorted by then to all the pension funds. Now this morning we're hearing whispers that actually it isn't it. Are there any comments about what on earth is going on there and what effect that's likely to have in the markets?
I wonder if I'd like to come here, but I'd love Gemma to come in a minute on the politics of what's going on. But perhaps I could just briefly come in on this point. I can turn to you. Clearly, the fire sale in the gilt market, the conventional gilt market after the mini budget, was a great concern. The Bank of England did the right thing at that time to step in as market maker of last resort. Yeah. There's been a lot of misguided comment describing this as QE. It wasn't QE. Yeah. It's a temporary purchase of bonds, as this committee knows, but it's worth just saying it in public again. Even last night I was trying to explain this to someone on some media programme who didn't understand it. These interventions will be drained and won't add permanently to the money stock in any way whatsoever. And they're entirely the right thing to do when gilts had to be sold in order to meet collateral margin calls that were going on in this pension market.
Because if that hadn't have happened, what would have happened is a sort of doom loop in the gilts market where things would have been sold off for even less of their value, of their real value.
Both in the nominal and the index-linked market.
Yeah.
We had a move in the index-linked market on Monday, which doubled real interest rates as priced in that market from 60 basis points to about 120 basis points. There's not been a movement of that magnitude for over 30 years. These are enormous changes, as you suggest, driven by a shortage of liquidity in that market. So the Bank of England extended these purchases that are due to end this Friday to include for the first time the index-linked bond market. And as you rightly say, the doubling of interest rates both in the index-linked bond market and the conventional bond market was a great concern, because you've then got prices that are suggesting market dysfunctionality and ultimately a threat to financial stability. So intervening in the market was the right thing to do. Your question then was about what happens next. There was a concern earlier this week that we were coming to a cliff edge on Friday where the interventions would not continue. So the Bank of England earlier this week adopted a repo facility, as you know, where people who need cash urgently now know they can sell their assets to their bank, and their banks can borrow that money as much as they require from the Bank of England in order to keep the liquidity going in that market. That new facility will extend until the 11th of November. So it's going to extend beyond our planned fiscal statement on the 31st of October and beyond the next MPC decision of the 3rd of November. And the hope is that that will allow the market to work its way through and allow liquidity to get back to the levels it has to in order to allow that market to function. Whether that's enough, we'll have to wait and see. But right now it does seem a sensible course. And I think, if I just make one point, and I think both of Torsten and Sanjay have summarised this very well, the real danger that we saw on the 23rd of September was obviously on the back of, I think everybody describes as guerrilla tactics against our independent economic institutions over the summer, the Treasury, the Bank of England and the OBR. And therefore it wasn't only the intervention on that date of what
guerrilla tactics by the government, let's be clear.
Well, I will leave you to finish that statement, but that undermined, that's a sense in which there was an undermining of the cooperative arrangement we had between the monetary and financial institutions that theoretically and in practice have led to lower interest rates and lower deficits than would otherwise have had to be the case. If you move away from that, what you're going to have is a succession of higher interest rates and higher deficits than you'd otherwise have, and it's precisely that projection that the markets were taking in the aftermath of the mini-budget on the 23rd of September, that if the government continued on this path, there would be higher deficits than otherwise and higher interest rates, not only as a result of the mini-budget, but as a result of successive statements into the future. And I think it's therefore very important that there is a commitment now from the government so that any fiscal event that requires tax changes will always be accompanied by an OBR forecast. There's not a world in which that shouldn't happen anymore, with appropriate signalling of policy alternatives as well. That's something we must think about as a result of what's happened. And it matters because lots of people have come to me concerned about where their mortgages will go, whether they can pay their bills, almost directly as a result of the mishandling of this mini-budget in the last 2 weeks. It's not the way policy should be run, it seems to me.
Thank you very much. Now, Dr. Tetler, you were wanting to say something briefly, but would you also think about how this terrible mess could be sensibly unwound. I mean, my view is probably abandon the tax cuts, but anyway, you might want to make an observation.
Yes, just briefly to follow up on Jagdit's points there about the extent to which part of the reaction and the problems have come not just from the specific announcements that were made, but by undermining and questioning the institutions that normally surround our fiscal and monetary policy making. And I would agree that it does seem that part of the problem has stemmed from that sort of questioning their credibility and not asking for a forecast from the OBR. I would agree with Jagjit that we ought to get forecasts alongside major tax changes. The only nuance I would add to that is that I think that is less necessary if you're doing temporary emergency interventions. And so there may have been a case this time, I think there was a case this time for perhaps having announced an emergency energy support package, time limited, doesn't affect the longer term fiscal sustainability of the UK public finances, which perhaps you could have done, well, may not affect the long-term sustainability of public finance, you could have done without a full OBR forecast. I think the problem this time was announcing permanent changes to the tax system, which didn't need to be announced so quickly. Most of them aren't coming in until April, so there was time to wait to get the full OBR forecast before announcing those policies. And the fact that they were rushed through so quickly, it's unlikely that that provided time for the new Chancellor to get a full briefing from Treasury officials on the potential impact of those changes and to think about them and to interact with the OBR about their longer term impacts. And it was those factors that together contributed, I think, to the concern that there was about this government's approach to public finances.
What a mess.